Hello, everyone, and a very warm welcome to today's major markets update for Friday, November the 22nd. Let's go straight to the bottom line. And what we find is that as long as last Friday's low holds, we must look higher for that subdividing wave 3. Namely, below that low, it will kick in that larger wave 4 before the wave 5 starts. Again, we remain bullish intermediate to long term for the NASDAQ, the SP 500, the Dow Jones, the NASDAQ 100, the IWM, and intermediate to short term only for the semiconductors, as we believe that one has still topped. Now, the Dow Jones this week suggests that the former is taking place, the subdividing a wave 3. As I pointed out in yesterday's written email, one, I don't see many people carry the subdividing wave 3, so it wouldn't surprise me if that happens. Not saying I'm better than everybody else, but oftentimes people will get surprised. And the other one is that we are in that ending diagonal. And once we've completed an ABC, it could suggest that third wave has completed, but it can easily tag on another ABC. And after that, another ABC. Moreover, we've not reached the 123.6% extension on the SP 500, which is at 6060. We've not reached it, and that is a typical minimal extension target for a third wave in a ending diagonal. We can go to 138.2 as well. So it really seems like it's your destiny to get there, so to say. And that means, we're either wrapping up a smaller fourth wave or in this case, a B wave. And now in this one, and then we complete the 3, then the 4, then the 5. So the question is, are we in this larger fourth wave or are we here? Well, the Dow Jones suggests we are here, though then the 3 wave is a top of A, the 4 is the top of a B, and then another C to go. All right. And as you know, we are 70% reliable, especially in EDs. We really have to queue of price levels because of the fast changing direction. You get A and then a B very fast, which takes a lot of people by surprise, and then the C wave happens. So it's a lot of quick turnarounds. Okay, so the environment of the market is changing. It's not a slow grind higher that you normally see in a third wave, which is just relentless. This is all ABCs overlapping. So this was the count we were tracking for the regular NASDAQ with the ABC. It is still possible. This week we just stopped right in the ideal wave B target zone. So it is still very possible. But again, we need to break below 18,650 to confirm this C wave. Until then, it is higher. That is, you can't nail the top. Don't front run anything from a trading perspective. The Q is a break below 18,650 if you would like to short this market. Because otherwise, look at the trend. It's higher, right? We're above the rising 20 to 50, 200-day. Look, it's a steep, continuous grind higher with, of course, some intra blips lower, but the general trend is higher. Okay, and again, you see this fast rip higher, then a drop lower, and maybe another fast rip is starting again. If we do not break below this low here, then this wave 4 will have to wait. And I think the NASDAQ will target 19,500 plus for a blue C. And then we can start the whole process over again. This is the NASDAQ 100 zoomed in. This is since March, the larger third wave top in the summer, the larger fourth wave low also in the summer, and now working and grinding higher on this ending diagonal. AB, 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 C. Again, we need to break below last Friday's low, and I don't care about how overlapping the price action has been over the last 5 days. As I said in yesterday's email, the price action of a ending diagonal for the first to third set of ABCs is indistinguishable from a corrective B wave because an ABC is a B wave, but an ABC tagged on with an ABC tagged on with another ABC is also a B wave, but it can also become the third wave in a ending diagonal. That is the problem. So we really have to go by price levels. And today, the first warning level for the bulls was below 20,700. Well, we stepped below it intraday, but we closed above it. We had a higher close than yesterday, which was a higher close than Wednesday, and that was about equal to Tuesday, and Tuesday was higher than Monday, etc. It is moving higher, and I don't care about the short-term overlap because that can also be ABCs. And ABCs can tag on to other ABCs, just as I mentioned. Moreover, the recent all-time high we did on the NASDAQ 100 did not get close to the 123.6% extension as 21,510. Okay, somewhere thereabouts. So there's room available to do that. And then we might see more negative divergence developing. We neither have, again, negative divergence on the technical indicators, just kind of like overbought conditions. I don't have the moving averages on this chart, but I have them on this one, and you can see we're just below the 10-day simple moving average. That's about it. If I would plot the 5-day, maybe we're above it. I don't really use it too much. And again, we have not broken below the warning levels of the bulls, and I can see that this red line is a little bit too low, and it needs to be right there at the green wave A. So even in this wave count, there is still upside potential left, right? We should go to 20,900, 2,100, somewhere around there. So we still have at least 125 points left for this count. So it's still possible, okay? It is still possible. We must give the benefit of the doubt to the bulls until we see the break below last Friday's low. Okay, that's it. Super simple. Until then, it is higher. The alternative, as I've shared that with you before, from a very bullish perspective, is that we are now in this wave 5. I find this less likely. I'm just kind of giving you the option. But this one is, of course, pointing much higher to about almost 23,000. But I'm not yet counting on it. We'll just keep it on the back burner. This is the alternative of alternatives, all right? The primary two wave counts are, of course, this one, which is based on the Dow Jones, though we don't want to compare indexes too much because the Dow Jones is up much more, of course, today than the technology sector. But this still seems to be favored, in my humble opinion. Then this is the alternative. This one will come into play when we go below last Friday's low, okay? So we focus, since it's a bullish trend, we focus on the bullish resolution, okay? That's what we're going to focus on, higher. Another one that suggests higher, as I already pointed out yesterday, is the Dow Jones, okay? So I think we're now in this C/3 wave of this larger third wave. It keeps subdividing higher. We're coming off very oversold conditions, so that matches things really well, and that we can now adjust the warning levels for the bulls because these ones were on the previous decline, and that one has been almost entirely retraced. So the first warning level for the bulls is pretty much today's low. The second one is then somewhere around, I would say, this level, 43,475-ish. The third warning level is, of course, below Tuesday's low, and then the final one remains the same. So, okay, we have, adjusted the warning levels for the current rally. This is a strong looking rally. As I pointed out yesterday, look where the Bollinger Band is going, it's moving higher. RSI5 is pointing higher. Price is back above the 10, the 20, the 50, 200-day moving average. Everything is rising. Everything's bullishly stacked. A buy signal above zero on the MACD. What more do you want? This is a bullish chart. End of story. So we're going to look higher. Continued on holding above Tuesday's low. That's for the Dow Jones. That's Tuesday's low. But as you can see, of course, if we already go below last Friday's low, that's a serious warning for the Dow Jones. Weekly chart, again, subdividing wave 5. All right, very possible. Okay, zero indication that the top is in place. We did not even close below last week's close, pretty much. That's where we opened, we dipped a little bit, and we rallied higher. New all-time closing high. Must be bearish. Just kidding. Semiconductors, yeah, today, of course, doesn't add any resolution to our preferred wave count. We still think this is in a wave 4 before this wave 5 starts. This is our preferred wave count. Why? Because we broke above the previous highs that were made intra-week, and we simply retested it. And if as long as this holds, we can move higher. Again, below 4,800, we'll target I would say 4650 to, let's make it 4600 to 4650, maybe 4550. Okay, so that remains the simple final line in the sand for the bulls, though I prefer to look higher. All right, S&P 500 preferred wave count. And we can, of course, now raise the warning levels for the bulls. We're coming off quite oversold levels, just as we did before. Okay, so if you would see here how much rally was left, quite a lot, right? From here to there, if you see that. Okay, of course, we get the if you same here, we're coming off oversold levels. There was quite some left with, of course, the usual blips in between. So the first warning level for the bulls is now, I would say, pretty much today's, I would say yesterday's open, somewhere around there. So we're going to take some of these boxes away to increase the understanding of the chart. Then, of course, yesterday's low is the second warning level. And then the third warning level would be, of course, Friday's low. And then, of course, the final warning level, I would put it at this. Yeah, I'll keep it at the second wave low there, right there. Why? Because if it's a larger fourth wave, it can still allow for some overlap, though it really shouldn't go below 38.2%. Okay, that'd be quite weird, so to say. So this is our preferred wave count. A C is 0.618 times A for the gray wave C. Targets again 6061. That is, as I said, the minimum upside target for a third wave in the ending diagonal. So then we have an ABC. So we tag on another ABC, just as we did here. Remember the March rally there? Nasty looking ABCs. It's not nasty, but it's ugly. Let's put it like that, overlapping. Soon we'll get a buy signal, and it wouldn't surprise me if we then start to see lower highs. Okay. So far, again, it looks like we're kind of slowly turning over on the MACD, but look at money flow. It's a liquidity driven market as always. So we still have some potential for a little bit more upside. The alternative remains that we're in this B wave, but we're almost running out of time and space for this one. It has to happen pretty much on Monday. Maybe we stall out and Tuesday, Wednesday, Thursday, Friday is going to be really bearish. But it's hard to be bearish with a positive money flow. It's better to be bearish on a negative money flow. Moving on to the IWM, this was the first wave count we had that we would see a bounce to what we said, 237.5 to about 240. We've been now in that target zone. It's been reached. Okay, so far that forecast was correct for higher prices. And we, of course, must see a turn down ASAP for this potential wave C of wave 4. It's potential, right? We're not saying, oh, this is going to happen with all certainty. The other one is that we would see this red B/2 and then a C/3. Well, again, we're right here at the borderline. Any higher, and this is not going to be valid. And then we're going to look at this one. Yes, the subdividing wave 3. Welcome to the ending diagonal with another stash or stack of ABC added to the previous ABC. It's all ABCs, right? AB, AB, AB. Unbelievable. Hallmark of a diagonal. So overlapping, and you have these quick turns. And of course, if we go above 242.5, the C of C of C of 3 is confirmed. And I think it can target somewhere around 245.5, somewhere around there. So we're getting awfully close already. Wouldn't surprise me at all. Then we get the fourth wave pullback and another fifth wave. Okay, that should really do it. I like it. And this could even be wave 3, by the way. This is then wave 4, 3, 4, 5. So to be determined. We'll get there when we get there. At least one more down-up sequence to complete this rally. At the most, 2 more down-up sequences. And again, you say, well, that doesn't match with the other indexes. This is in its own world. Small caps ain't large caps. Very simple. Bullish chart. Look at those 1, 2, 3, 4 bullish candles in a row. Big, juicy candles we have here. Okay, so this is bullish. We're above the 20, the 50, the 200 day. Everything is rising. Bullish chart. So I prefer to look higher to 245. So we've turned things around. Remember, we already said last week we're going to look for a bounce. We've reached the target zone. If you took your chips off the table, congratulations, you have a winning trade. That is what matters. So now we're going to look higher yet, and I'm going to, of course, adjust the warning levels for this chart. Not from they're not bearish anymore, but they're now bullish warning levels, meaning these are the warning levels that the bulls need to take into consideration. Not bulls. So the final warning level is, of course, Monday's low. The first warning level is somewhere around here, 235. And then the second warning level, I would place it somewhere just about there. You see this? This is about just south of 233. And then the third warning level would be right there at about 228.5-ish. So these are the warning levels for the bulls, right? So we got some leeway. Okay, so those are the indexes. Now things start to align a little bit. Again, based on the Dow Jones, I think we should expect higher prices. That is quite a bullish candle with a new all-time closing high on a weekly basis. All right, and IWM as well. Semiconductors, yeah. Let's look at market breadth. Again, we've had zero negative divergence on the bullish percent index for the regular NASDAQ, which often doesn't go inside with a top, right? We have increasing price, increasing bullish percent index. It's nothing to write home about. This is not like a kickoff wave as we saw here in 2021 when we are going almost to 80, 90. So it's just like 55% is on a buy signal of all the stocks that make up the NASDAQ 100. But you know, up is up. So we have no negative divergence, and that's what we like to see at a minimum to suggest a larger top is in place. The bullish percent index for the SP 500 does show this negative divergence. So we'll keep an eye on it. But again, these are conditions, not trade triggers. But we knew, you know, once we start to get very overbought, meaning over 80, somewhere around there, you have to start to look for short-term pullbacks at the minimum. And that's what we got. And now we're starting to move higher and with potentially more negative divergence. All our conditions, not trade triggers. How are we doing on the new lows? Benign, 26, yeah, double digits. Okay, so it seems like the worst is behind us. This is, by the way, the NYSE. Look at that, new trading all-time high. This is bullish. This is just, look at this. I cannot be bearish on that one. So McClellan oscillator firmly positive now. We are in 40 territory, bullish. All right. So today's reading is higher than yesterday's reading, even with this minimal higher close compared to yesterday, up almost 50% or so, actually 115%, a double today compared to yesterday. Yesterday we were in the 20s, now in the 40s. This is good. Okay, oh, it's good, period, end of story. This also shows us now positive divergence on the daily RSI 14 for the summation index. For those new and unfamiliar with this indicator, it is the yesterday's reading of the McClellan oscillator added to that of today, and yesterday was an added to the previous day, etc. So it's just summing up every single reading. Positive readings and the summation index will start to increase. Negative readings and the summation index will start to drop. And as you can see, we're coming off very oversold levels. This we call the ebb and flood indicator. As things start to get very oversold, right? We're pretty much hitting rock bottom. There's nothing more left for the water to retreat, right? There's no more water left. So now water can start flooding back into the market, which will, of course, increase price. Soon we can get a buy signal, and that is positive for the market as well. I've been pointing this indicator out for quite some time. It doesn't work all the time because, as you know, 60% of the time it works every time. That's what they tell us, and that's indeed true for every single indicator, for every single method, for every single. That's about what you get. About 60-70% of the time it works. Okay, and that's a big fat edge. Las Vegas is rich because they have about a 49 versus 51%. The house is 51%, you have 49%. That 1 to 2% difference makes all the difference in where the money eventually ends up. Not in your pocket most of the time. That's why their casinos are so lavish. Anyway, maybe you can beat the system. I don't know. I don't gamble. I like Las Vegas. I love it. They have a Formula One race there this weekend. So go watch it. It's great. Fastest cars on the planet, pretty much. Not necessarily in a straight line, but definitely through corners because of huge amounts of downforce. And yeah, unfortunately, they drive it at night. It's great. It looks great, but it looks like they're on the North Pole. It's really cold. And it's not very Las Vegas-y. Las Vegas needs to be hot. Anyways, back to... what matters, buy signal on the PMO. It's not ideal, but it's a buy signal. Okay, I did want to point out that we never gave a confirmed sell, and that one needs to be there. We never got this confirmed sell signal. Okay, that is the KST of the PMO, right? It kind of smooths things out. And yes, we got a sell signal previously, but it wasn't confirmed by the KST. That's kind of the level you're looking for. I don't know why it puts it there, but it was never confirmed sell signal. That's the bottom line. AD line, well, if it's not going to stop, then the negative divergence we had between October and November will have been erased. Interesting. Okay. And if there's no negative divergence, the bear market has been postponed for quite a while. And this is our longer term trend indicator, also still 100% bullish. Okay, so longer term trends start to, or actually still look bullish. AD line might erase its negative divergence. Well, to be determined. This is why we're tracking it. It's not a trade trigger. It's just tracking it to see if it gives us further clues on if we're topping out or not. And so far, it doesn't really look like it. Right? So breadth follows price or price follows breadth. Yeah, I don't know. One of the two. Both are bullish. Both are pointing up. And the PMO is getting a buy. So, yeah, this is giving a buy. We're coming off positive divergence. That's really nice. Last time we had positive divergence was in October, November. See that here? Lower price and off to the races. Here we do have a loss in momentum, but we have a higher price. So it's not truly positive divergence, just that the momentum. And again, we have a rally on negative breadth. We've had it before. Okay, so this market really likes to rally on negative breadth, just like we had here in the beginning of 2024. You see that? So breadth declined, the market just waltzed straight through it. And we had it here as well in the summer. See that? Yeah, eventually they were followed by decent declines, as you can see, but the market can completely ignore the fact that more stocks are declining than advancing. Okay, it's just because it's a weighted index, and then of course the big cap in stocks add a lot more weight to the index. And we're not going to look then at the other indexes. This is the one we trade. This is the one we look at. We're not going to look at the South Pole to know what the North Pole is doing. Very simple. Okay, both are cold, but both are completely different continents. So that's what we have for this week. Again, last week we were looking for a bounce at the minimum, and that's what we got. And it seems like we now need to change our stance, and the preferred stance is that we are in this final C wave higher, contingent on holding above last week's low. If we do not hold above last week's low, we can still see 5,800. We have to drop below 5,400 on the SP 500 to tell us this bull market is over. That's how low things have to go. So we have almost 600 points of leeway for the bulls to try to fill things in differently than we are currently tracking. So this still remains a bull market. Look at the S&P 500 for a last time, and we are above the 10, the 20, the 50, the 200-day moving average. We're coming off oversold levels, all those good things. Market breadth indicators are also turning around. So I think we have to look higher, and as usual, contingent on holding at least above yesterday's low and preferably above Friday's low. Below Friday's low, we're going to look for 5,700s on the S&P 500. We're going to look for about 19,000, 20,000 for the NASDAQ 100, not 19,000 all the way, but so high 19,000 to low 20,000. And even for a bounce, there's still some room left, but we prefer the bullish wave count for now. And I hope you appreciate that insight. Take care, trade safe, and if you have any questions, please let me know. I'm here to help. This is not an easy market, especially not in the ending diagonal with lots of overlap, fast moves, both to the upside and the downside, that can then again quickly be reversed. That's the problem. As you see, where you have these huge gap downs and then you get big gap ups. So stick with it for now. Take care, trade safe, and I'll catch you all next week.